How's everyone doing, by the way? Yeah, that's good, Tiffany. Absolutely. Yeah, everything's good. Just it's been a great day so far, and ready to host this webinar. Absolutely, absolutely. Hey, what's going on, Josh? Yeah, how's it going? Yeah, doing pretty good. Got some pretty good internet connection in Kenya? That's good. That's good. Absolutely. It's definitely good. All right, so yeah, we'll be getting started in just about 2 minutes or so. And today we'll be talking about the Biden tax plan that is set to probably pass at the end of this year. They'll definitely get all the COVID stuff taken care of for this year. But you'll most likely see a new tax policy, as if we needed a new one, but a brand new tax policy that will be passed by the end of the year. And this webinar will be about an hour. So typically what I do is I present for about 45 minutes, 45 to 50 minutes, and then we leave some time at the end for some Q&A. Now, while you're on, just a few housekeeping items. For one, we are streaming live on Instagram. So literally to my right of my screen is Instagram, and then to my left is Facebook. And then we also have the Zoom platform. For those that don't know, Zoom is where we do our main webinar. And we also have, that's where we do the presentation, like the actual slides. So if you do want to watch the slides, we did post a flyer on our Facebook and Instagram pages if you want the Zoom link. For those that are on Zoom, if you know somebody will benefit from this information, feel free to send them the Zoom link and we'll be sure to get it going. You can ask questions at any time, right? Or if you want, you can say, okay, let me just save it for the end. We will have 10 to 15 minutes of Q&A at the end, I promise. This is a 1-hour webinar. It will be recorded, so for those on Zoom, this is your disclaimer that this is a recorded webinar. So let me go ahead and start the recording. Actually, let me let somebody in the meeting room first. And then, so we got 2 people looking to join. Okay. So let me see who this is. Okay. All right. So as soon as the next person joins the webinar, we'll go ahead and get started with the recording and everything like that. We do ask that you mute your mic if you're not speaking, and so that's something to keep in mind. All right, so it looks like we got 2 more people joining, so we'll go ahead and first start the recording. Actually, let me do this really quick. All right, so let's first start the screen share, and then let's go ahead and start the recording, if I can find where the record button is. Okay, here we go. All right, so thank you guys once again for joining this webinar today. And today we're streaming live on Facebook, Instagram, and we're live on Zoom. And this is recorded, right? So if you miss anything, this is something that is recorded. For those that are on Zoom, a few housekeeping items. We do ask that if you're not speaking, you mute your mic. You can ask questions at any time, either in the chat box below, or you can just unmute yourself and ask your question. For those that are on Instagram, on Facebook, you simply type in the chat box and then I'll be answering your question. We will have a formal Q&A at the end today, basically to cover any questions that you may have. That's about 10 to 15 minutes, so we'll be going on until about 12:50. This is a pretty in-depth webinar, so there is a lot of information that will be unpacked. So I encourage you all to take notes, and if not, rewatch it and ask any questions. So today we'll be talking about current law versus Biden proposed tax policy. And I'll just scratch the word proposed to will happen tax policy. Yesterday there was a major thing that happened. basically there was an election in Georgia, and the Democratic Party won the Georgia election, which of course caused mayhem, for lack of a better term, in Congress or at the White House. And so there's a reason for all of that, right? This is not just happening just to happen. There's a true reason for that. But let's just go ahead and start sharing about the agenda for today. So we'll start by comparing the current law versus the proposed changes. Then we'll talk about tax rate changes, right? We'll talk about itemized deductions, tax credits, additional proposals, changes. So some things that are even beyond what we're talking about today. And then what are some different things you can do, right? What are some things you can do now, not when the tax plan gets passed, but I'm talking about right now that you know. So don't let me be the one to say I told you so. But let's just say when the tax plan does pass, you would be in the best position possible. And of course, we do offer tax planning as a service within Badu Tax Services, which is our #1 service right now. And especially over the next 4 years, will certainly be our #1 service. And then I'll leave my contact information at the end, just in case you guys want to reach out to me and ask for any support. Let me just start with an introduction of who I am. My name is Jeff Badu, and I'm a parallel entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprises, LLC, which is a multinational conglomerate in the finance industry. What we do is we provide a suite of financial services, including our marquee company, which is Badu Tax Services. And what we do there is we do tax preparation, tax planning, right, our #1 service, and tax representation for individuals and businesses across all 50 states in the U.S. And we have clients in about 15 countries, which hint, hint, we have somebody from Kenya today that joined us, on our webinar. So that's actually one of the countries that we do represent. So with that, what I do is I basically help people multiply their wealth. I'm a parallel entrepreneur and a wealth multiplier. And my purpose in life is to inspire and support the super hungry to take hold of infinite resources, aka this webinar, in order to create an abundant lifestyle. So basically, one thing I always like to say is I don't have a crystal ball. I can't predict the future, but I can use certain patterns in order to help me make better decisions in the future. And that's exactly what I do for my clients as well. So let's talk about a timeline. So there was an election that happened on November 3rd. And of course, we got a new president who got elected, or who's now certified officially our next president for this year, the next 4 years. And then all of a sudden, we have this COVID-19 package that passed. Of course, we went through that yesterday. For those that didn't catch the webinar, we did record that as well. But we had this coronavirus omnibus bill, stimulus bill that was passed, and that was probably less than 2 weeks ago, actually. So we do have a new stimulus package that was passed. So basically right now what you have to do is you have to be doing some planning, right? We are in tax season, right? Which tax season is going to end April 15th, and then there's an extension of October 15th. The tax deadline has not been extended, by the way. So we do still have the same deadline for tax season. Nothing has been extended. But as usual, if you want an extension, you can file one that extends you out until October 15th. If you have a partnership or an S corporation, your deadline is March 15th, not April 15th. Your extended deadline, if you file an extension, is September 15th. So we got to get our taxes done. That's a given, right? Get your stimulus, get all that good stuff. Today we're talking about how do we plan for the future. Talking about the post-COVID. I mean, we are technically still in COVID, but at least post the COVID bill, post the elections, post the things that have been happening. So now, and by the way, this is good for at least until 2022. This presentation that we're talking about today is probably going to be good for another 12 months. All right, so a few disclaimers. For one, the Biden tax policy is not actual law yet. Anything I tell you today is only a potential. but I can imagine that it will become law at a certain point in time. So I know you're going to hear a lot of disclaimers today, but let's just say that those aren't true disclaimers, because I predict what I'm telling you today will happen in the future. The suggested changes were made to entice voters to elect the campaign, right? Therefore, key details have not been laid out or set in stone, so this is not 100% in writing. Nobody's put their blood or stamp on it yet. Most likely, the proposed policies must make it through the House, which is controlled by the Democrats, and then also the Senate, which basically is kind of a wash, but let's just say the Democrats now basically control everything before it's signed off by our next president, Joe Biden. Additional details will be provided, when it enters the House and the Senate for review and approval. So there is a process that happens, just like the stimulus package. It went through an actual process. It didn't just get signed. It went through debates. It went through a lot of different things. It wasn't just, oh yeah, let's just go ahead and pass it. As a matter of fact, our current president said he wouldn't pass it. But then he ended up doing it anyway, because he thought that the $2,000 stimulus checks will be released. And now Republicans have basically, and this is not a political debate, by the way, but Republicans have shot themselves in the foot by not passing the $2,000, and now we may even get a $10,000 stimulus check. That's as high as we could potentially go. One thing to note, though, is the more stimulus we put out there, the more stuff you receive, it later comes back and bites you, not in a bad way per se, not as if you intended to do it, but just understand the way that the system works is that if more money is being released, if student loans are being forgiven, then somebody has to pay for it. And unfortunately, it is us that are on this webinar today. So the purpose of this webinar is, how do we not be those people? And how do we avoid that situation? Because in order for the government to sustain and run, they need money. The money comes from tax revenue. So the reason why this is so important is because the Biden administration will increase taxes, because all the stimulus, right, that happened has to be paid by somebody. And unfortunately, it is us, the American citizens, the people that pay taxes into the tax system. So if you hear about student loan forgiveness, if you hear about more stimulus, it's great. I love it. But just keep in mind, somebody has to pay for it. It's not free. It's something that somebody's got to pay for it. Whether it's me, whether it's you, whether it's your parents, whether it's your grandparents, somebody's got to pay for this. So just keep that in mind. There's going to be a lot of stuff over the next 4 years. And it sucks that we're in a pandemic, but it is what's really controlling the economy and what's controlling everything that we're talking about right now. At the end of 2019, the U.S. government was in about $1 trillion worth of debt. At the end of 2020, $3 trillion. And at the end of this year, we might get into the 10 trillion, right? That's pretty scary. So yes, if you're in the U.S. government, your government is in debt. Now, what to expect? With COVID, we witnessed a rush order of process, on enacting the CARES Act, the FFCRA, and to add the omnibus, we call it the Coronabus, bill that was just passed a few weeks ago. Normally, tax legislative changes take a longer period to narrow down details before enacting. In addition, it is also rare to see retroactive changes, however, not impossible. All that means is that anything I talk about today will not be effective as of 2020. So 2020's taxes will not be effective, although it's possible. And most likely 2021, since we're already in the fiscal year, is also not going to change. So what happens is that you should consider being prepared if there are retroactive tax law legislative changes for 2021. But most likely what's going to happen is by the end of this year, Biden is going to ink his signature on his tax plan, and that's going to be effective 2022 moving forward. So not 2021, but effective. It's going to come out in 2021, but it's effective 2022. So that means you have the opportunity to do things this year. You got a full 360 or so days to do something about this. What to expect with the changes? Here's a quick timeline. We have the, basically, let's start from the bottom to the top. We had the Omnibus Budget Reconciliation Act of 1993. It was signed on August 10th, 1993, and passed on January 1st. And I believe, it was actually effective 1993. Then you had the Patient Protection and Affordable Care Act. That was basically, signed, and that was the Obama administration, March 23rd, 2010, and then it was effective, though, 3 years after that, January 1st, 2013. It was not retroactive. The first one I mentioned earlier was retroactive. Then you had the American Taxpayer Relief Act, and that was signed January 2nd, 2013. Also, that was a part of the, the Obama administration. And that was effective January 1st, 2013. And yes, it was effective. It was retroactive. Then you had the Tax Cuts and Jobs Act. That's when Trump came in. And that was signed on December 22nd, 2017. So yeah, I got a big Christmas gift of a big tax reform, that I had to read through. And then it was effective January 1st, 2018. It was not retroactive. So keep in mind, some stuff can be retroactive to the beginning of this year. Then you had the CARES Act, and that was passed due to COVID-19. That was signed March 27th, 2020. But it wasn't passed until March 31st, 2020. So literally 4 days after that. And then you had the FFCRA. That was the Family First Act as part of the COVID. That was signed March 18, 2020, effective April 1st, 2020. And now, where are we? Let me add to this chart, by the way. You had the Omnibus, coronavirus package that was signed 2 Sundays ago, effective 2 Sundays ago, basically. So that one, there's still stuff that's going out, but it's already effective. And now you have the Biden tax hikes. We call this the Biden tax hikes, Biden tax policies. Who knows when it's going to be signed? I think it will be signed. It's very safe to assume it will be signed. So anything I tell you today is most likely going to happen. It hasn't happened yet, but I'm basically telling you that it's most likely going to happen. So now let's talk about some tax rate changes. So right now, let's walk through some of the things for 2021. And of course, this is proposed. It is not actual law yet. Right now, the corporate tax rate is at a flat 21%. Under Biden, though, it would be 28%. So he does plan to increase taxes for corporations. The capital gains tax top rate, so when you sell a house or when you sell something, the highest rate is typically 20%, but proposed 40%, 39.6 to be exact. But let's be realistic and round it off to 40%. Then you have the top individual income tax rate, which is currently 37%, but it would go up to 40%. Then the Fica tax, the one we all hate, the Social Security tax, which Social Security will probably not be around in the future. It is one of the biggest Ponzi schemes in the world, if you guys haven't heard, where you keep paying into it and then it pays out, then you keep paying into it and it pays out. Eventually that's going to run out and there won't be any more money. It's a legal Ponzi scheme. So you don't need Bernie Madoff to be called a Ponzi scheme. But basically with that, there's a 6.2% rate that stops at $137,000. And then under the Biden administration, it would continue if you go over 400,000. So really the administration is targeting those who make $400,000 or more. That's who they're really targeting in order to hike the taxes on. The top effective rate on pass-through income would go from 30% all the way to 40%. I mean, that's insane. The estate tax rate. So when somebody dies, let's say Prince, rest in peace to him. When he passed away, he probably paid 40% estate tax. So that means that if he made $1 million in his estate, hypothetically, $400,000 went to the government. So he was in a 40-60 partnership with the government, unfortunately. And that's how a lot of people end up too, by the way, if you don't do estate tax planning. But under the Biden administration, it would go up to 45%. And that's quite insane. That means if somebody passes away and their estate is worth a certain amount, they have to pay a 45% tax rate, meaning their beneficiaries literally lose 45% of the money to taxes. And that's not including the state, by the way. For example, the state of Illinois, you have you basically have tax rates there too. So this is just federal. Some of you may have heard that the tax rates might go up to as high as 60% if you include federal and state. And yes, that is correct. You did hear that right. If you're in California or New York, you might be paying up to 60% in income taxes. For those that live there, I don't know if you might want to move there. So we just went through this, so I won't go over it again. But let's just talk about the corporate tax rate for a second. So overall, the Tax Cuts and Jobs Act reduced the corporate tax rate to a flat rate of 21%. Under the Biden administration, it would go up to 28%. So let's talk about a case study really quick. We have this company called Philco, and that's a C corporation, and they have a net income of $3.5 million. Now, they would basically be paying an additional $245,000, yes, you heard that right, $245,000 in income tax under the Biden plan when compared to the current law. So here's a case study that compares it. So you have the taxable income at $3.5 million, and the tax rate currently is 21%. Then under the Biden administration, it would be 28%, right? So the tax due on that would be $735,000 under the current law, but it would be $980,000 under the Biden administration. That's an increase of $245,000. What are some things you can do? This is what we're all about. We're all about being proactive and planning ahead. Consider taking dividends or retained earnings before, so please excuse the typo. It should not say 2020. It should say 2021. So before 2021, you might want to consider taking out some dividends to take advantage of the lower dividend rate or the lower long-term capital gains rate. So when you take out a dividend from a C corporation is subject to double taxation, meaning not only do you pay taxes on the profits, but whenever you take out money, you also have to pay taxes. And currently it's at a rate of 20% as the higher rate, but under the Biden administration, it's going to be 40%. So not only are you getting crushed on the C Corp rate, or the tax return, but you're also getting crushed on your personal tax return. What can you do? Consider moving from a C corporation to an S corporation to avoid double taxation, at the 28 and 40% basically, and determine whether to make this change now. Remember, you have the right to act now. You don't have to wait for anybody. You don't have to. Don't let me be the one to tell you this, right? Just go ahead and start planning ahead. And remember, tax planning is the #1 service that we offer in our firm. We spend a lot of time with this. Somebody asked a question, curious, how does it affect LLCs and sole proprietors? So LLCs and sole proprietors are pass-through entities, so they get taxed at your ordinary income tax rate. So on the previous slide, you would be taxed at 40% as the highest rate, essentially. Taxes will go up for sole proprietors and LLCs as well. So now let's talk about the capital gains rate. So the capital gains, when you sell something, you have to pay capital gains tax. Let's say you sold your home or you sold an investment property. Currently, there are 3 rates for capital gains: 0%, 15%, and 20%. The Biden plan would increase the capital gains rate for high-income individuals, ones who are making over $1 million. With the $1 million threshold, capital gains would be taxed at the highest individual tax rate, aka 39.6%, as opposed to the 20%. We do not have details on the implementation of this tax increase. A potential assumption in the deployment of this change would be to start the 39.6% capital gains tax rate for taxpayers making over $1 million, allowing a fourth tax bracket to the tax table. So you would have 0%, 15%, 20%, and then 39.6% if you make over $1 million in capital gains, or taxpayers making over $1 million. So that's pretty much what would happen there. Now let's look at the tax schedule. I won't necessarily read all of this one, but basically right now basically under the current law, the tax rate effectively is it's actually starting out at 10%. So 10% is the lowest tax rate right now. Under the Biden administration, it would still be 10%. Technically, 0% is a tax rate because if you don't make any money, you don't pay any taxes. And then there's the highest tax rate right now is 37%. But let's talk about it in the sense of capital gains for a second. So 0% is the lowest capital gains tax rate, and the highest is 20%. So if you make over $441,000 as a single individual from a capital gains standpoint, then you pay 20%. Under the Biden administration, if you make over $1 million, then you'd be paying 40%. So that's just one way to think about it. Now let's just do another case study really quick. So after working hard for 25 years, let's say Sally sold her business, Acme Industries, for a net profit of $2.5 million. So for those who are looking to sell their business, please pay attention to this one. But the gain from the sale will be taxed at the capital gains rate. Let's compare the results under the current law and the Biden plan. So the current law, the capital gain, that they sold the business for would be $2.5 million. The capital gains rate, the tax they would pay on that is $463,000. Ouch. But even more ouch is $757,000 under the Biden administration. The difference is an increase of $294,000. What are some of the things you can do? Consider selling this year as opposed to next year. And consider gifting, so you can start gifting appreciated assets, right? So let's say you have a building, you have a real estate property you bought for $100,000. It's now worth $500,000. Consider gifting some of that maybe to a charity, so that you can get the tax deduction first of all, and then you don't have to pay the capital gains tax. You always have the right to gift something to a charity if it's gone up in value. So just something to keep in mind there. All right, so basically, yeah, this is just showing you an example of what would happen if somebody who sold something for $2.5 million under the current administration versus the Biden administration. This is what the difference would be ultimately, the $294,000 in increased taxes. So now let's talk about from an individual, aka a sole prop or standpoint. So the Biden plan would increase the current highest individual income tax rate to 39.6%, up from 37%. The current marginal income tax rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%, with thresholds for each of these rates varying depending on your filing status. And there's no further details that have been provided related to this calculation. But basically, the assumption is that the 39.6% would start at those making $400,000 or more. So here's the theme of that. Joe Biden will not raise taxes on anyone making less than $400,000. That's the assumption. So if you're making less than $400,000, you might be okay, right? But he will ask wealthy Americans and big corporations to pay their quote-unquote fair share, whatever that number is. And in some cases, zero for companies like Amazon. For single, married, filing joint, head of household, qualifying widow or we are making an assumption that the upper bracket would start at $400,000, rather than simply replacing the 37% bracket with a 39.6%. So basically there would be an extra bracket, aka the 39.6%. So here's how the tax chart or the tax rates would look like. You would go from 10%. 10% would still be the lowest rate, and then 37% would be the highest, which is the current law. Under the Biden administration, once you hit $400,000 or more, or over 400,000, then it jumps up to 39.6%. And we actually assume that they would replace the 39.6% with the 37%. They still haven't clarified that part yet, but that's some of the stuff that they debate in Congress. Now, one thing to note is that even if you're in a 32% tax bracket, it doesn't mean you pay 32% in taxes. It just means that on average, that's where you would fall from a marginal standpoint. So basically, your effective tax rate, the true tax you pay, may be lower than 32% if you're in a 32% bracket. It's a bit confusing, but basically understand that when you're in a bracket, it doesn't mean that's your true tax rate. For example, if you're making $0, you're not paying 10% taxes. You're paying 0%, 0% taxes. So just something to keep in mind. And then ultimately, this is for married filing separately, and then you have head of household. So let's do another case study. Let's say you have an individual who is making $800,000 in W-2 income. He also has $1.8 million in capital gains. Maybe he sold his house or he sold a property. So under the current law, he would pay taxes of $260,000, which is not bad on his W-2 income. Well, actually, if you really think about it, that's pretty terrible to pay $260,000 in taxes on $800,000 worth of income. Under the Biden plan, though, he would go up by $273,000, and the difference would be $12,768. I'm sorry, $12,768. And then he would pay an extra FICA taxes of $24,800. Under the current law, he would pay FICA taxes of $8,537, but now he would pay $33,337 under the Biden, just because he makes over $400,000. And then his capital gains tax will go up from $323,000 up to $479,000, an increase of $156,000. What's the difference? That literally means that he's going to pay $194,000 extra in taxes. That means he's going to pay $479,000 in taxes. That's insane. What are some of the things you could do? You can accelerate some of your income in 2021, right, through converting traditional IRAs to Roth IRAs. That's something you can do. You can do things like exercising stock options. You can take on bonuses early. And then you can determine how long you can defer income and wait for possible tax cuts, perhaps 4 to 8 years. We know for the next 4 years, this is going to be effective. But it could take up to 8 years for this to wind down, this new plan. What does this really mean? If you're a doctor or lawyer, I think you should start investing in some real estate, or you should start doing something that's going to help you get ahead. Find a way to reallocate your income. For example, this W-2 income, maybe find a way to turn it into 1099 income. By the way, I said this 4 years ago in 2017. Find a way to turn your W-2 income to 1099 income so that you can start deducting things such as travel, meals, utilities, things of that nature. Right? So start finding ways to rechannel your income and start finding ways to become a real estate investor. That's one of the most powerful ways to save on taxes, is to have your active income and then also have real estate that can help reduce your active income. When you invest in real estate, the government incentivizes you in the form of a tax deduction or credit. Now let's talk about the complicated concept of the elimination of the Social Security tax cap. Currently it stops at $137,000, but under Biden it continues over $400,000. I mean, that's quite a lot. So this one, basically, currently both employers and employees pay the quote-unquote old age survivors and disability insurance. Social Security, FICA, right? Those are terms used interchangeably. they pay a tax of 6.2% on each wage up to $137,000. Then after that, after the $137,000, there's no additional taxes paid by either party. The Biden plan, though, will start taxing Social Security again for wages over $400,000. This will leave a donut hole between $137,000, excuse me, and $400,000 that will not be taxed. But this new threshold has no upper limit. So all wages above $400,000 will be taxed at 6.2% for the employer and the employee. That's a lot. The portion of the wages below $137,000 will continue to be taxed as they currently are. So to the right is a chart. What are some of the things you might want to think about? Somehow, some way, consider switching to an S corporation. Right? If you're a Schedule C, if you're a sole proprietor, you might want to think about being an S corporation. That is definitely one big tax planning tool that we use. Consider deferred compensation strategies to avoid this Fica tax. And then consider adding additional retirement strategies, maybe traditional 401ks and IRAs to help. Of course, you wouldn't be eligible for a traditional IRA if you already have a 401k at that level of income, in order to reduce taxable wages. So here's a quick chart of an example, just different examples showing you the differences. So we won't really get into the weeds of that. And then there's a phase out of the Section 199A deduction. So if you own a small business, let me just go into that. Currently, unincorporated businesses or a pass-through entity, basically, are eligible for a 20% deduction based on qualified business income. The Biden plan would phase out at above $400,000. So if your net profit is above $400,000, then they would phase you out of the QBI, they call it for short, or the 199A deduction. Of course, we don't have details on the full phase out, but it's safe to assume that the QBI or the Section 199A is phased out for specified service businesses. So if you're a lawyer, an accountant, or if you're somebody who provides specialized services, then you're already phased out of certain, there's certain phase outs. And this new limitation would most impact those businesses with high W-2 wages and also businesses that have significant unadjusted bases immediately after the QBI. It's a very complicated concept. Won't really get too deep into that, but let's just go through a case study. We have a guy named Louise Jefferson, a girl named Louise, let's just call her Miss Jefferson, who runs a dry cleaning business. And the business is currently organized as a Schedule C sole proprietor. And she's on track to receive $1.2 million in gross income in 2020. And then she expects to pay $400,000 in employee wages this year and will have $150,000 in expenses. So that means her net income is $700,000. By the way, if we saw this as a client, immediately that's a tax plan that we're proposing to the client. Immediately. She would like to know what her tax bill would look like under the current law compared to the Biden plan. So if her gross wages are 1.2, and then she has employee wages of $400,000, other expenses of $150,000, net income of $700,000, that's quite a bit of taxes. Here are some things that you can consider. You can consider accelerating some business income in 2021. Consider additional planning strategies to reduce income below the phase-out level. So under the Biden plan, she would pay an additional $84,000 in taxes, right, which is huge. And then she would not receive a tax deduction of $136,000 because she's phased out of the QBI. And then if she's single, she's paying a 40% tax rate. That would result in an increase in income taxes, additionally, of $53,000. Right, so that's a pretty massive, basically losing out. She's losing out on a lot. So overall, when it's all said and done, when you run the numbers, she's losing out on $84,000 worth of money that she could have very well put towards her retirement. And why is it important to talk about taxes, by the way? Because we would hate for anybody to overpay in taxes. Last but not least, let's talk about the estate tax rate. This one doesn't apply to most people, but when somebody dies, when somebody passes away, unfortunately, they do have to pay taxes, right? You don't just leave this world and just, it's done, unfortunately. And, you know, this is also a biblical concept too, by the way. But this is called the death tax. So in 2020, the current estate and gift exclusion was at 11.58 million. So if your estate is worth under 11.58 million, you don't have to pay any estate taxes. And then 23.16 million for couples. I mean, that was sweet. If your estate was worth over $20 million, under 20 million, then you didn't have to pay any estate tax. The Biden plan would roll these exclusions back to the 2009 levels. I mean, that's insane. This would result in a estate tax exclusion of only 3.5 million per individual. So for those that are high net worth or ultra high net worth, you're definitely going to be impacted by this. It would also cap lifetime gifts at $1 million. And the Biden plan would also increase the taxes from 40% to 45%. By the way, this is proposed, but this is what you're looking at for 2022 moving forward and potentially retroactive to 2021. So, I mean, that's a decrease of $8 million in the exemption. If you multiply that by 2, by the way, one of the best tax planning strategies is to get married, right? Not saying that's the only reason, but that is a good reason to get married. You know, so that's a decrease of $16 million that you're leaving on the table for your family. Some things to consider is consider gifting of income producing assets, right? So start doing some gifts using trusts, just using estate planning. Estate planning is very important. And then consider business valuation when assets value may have decreased because of COVID. Consider potential family deaths that may occur in the near future. Of course, nobody can predict this. But if you have an uncle, if you have somebody who's aging and they have a sizable estate that you know about, then please send this information to them. This next concept is extremely complicated, but let's just say, let's just use an example, right? I think this is important for you guys to understand as you approach the high net worth. But currently, assets that are passed to beneficiaries upon a taxpayer's death are valued at the current value rather than at the basis when they are purchased. For example, your parent bought a building at $100,000 and it's currently worth $500,000. And unfortunately, they pass away and in this year. So they give it to you for $500,000, right? You get a building worth $500,000 and that's what it's worth to you. You can sell it and not pay any taxes on it. However, under the Biden plan, if you were to sell it, you'd have to pay taxes on $400,000 because there's no quote unquote step up in basis. So this stepped up basis means that the asset passes down to the beneficiary at a much lower tax than had it been sold by the original owner. So if your father sold it, he would be paying a hefty tax. But if it passes to you, you don't pay any tax. You know, so that's just something to keep in mind. Somebody quickly asked a question, what about write-offs? That hasn't changed. I don't think they'll necessarily change that one. I mean, actually they might, but hey, I don't think they're really targeting businesses, small businesses per se. They're targeting large corporations like Amazon and Microsoft, those companies that have the big, tax breaks. Of course, they're going to lobby like crazy to get what they want because they're the ones that employ the, people in the U.S. And the Biden plan proposes to eliminate the stepped up basis. So you don't get the stepped up basis. So essentially, you're going to get it at the original price that the person who passed it down to you bought it for. So that's pretty big, right? And let's just, there is a case study in here, but for the sake of time, let's just skip through this one. And there are a few things to note too. So the Biden plan proposes several changes to itemized deductions. First, it would eliminate the current $10,000 state and local tax limitation, which is good, right? That was something that was implemented by the Tax Cuts and Jobs Act, so that's something that would go away. It would cap itemized deductions at 28% of adjusted gross income if you earn more than $400,000, and then it would bring back the piece, they called it the piece limitation of for taxpayers earning over $400,000. A few things you can do right now is you might want to do larger donations this year. You might want to bunch up deductions in off years. So now let's talk about retirement accounts. The Biden plan would eliminate the current deduction for 401ks, Iras, and other retirement accounts. I mean, that's crazy, right? Instead of a deduction, a refundable credit of 26% would be implemented. So he would take away traditional 401ks, IRAs, and this would be a benefit for lower income taxpayers, but will result in a lower deduction for higher income taxpayers. So something you can do now is you can reduce your taxable income so that your marginal tax rate is below 26%. And basically that would maximize your retirement deduction. Now let's talk about tax credits. The earned income tax credit is basically he would expand the earned income tax credit for anybody who's over 65. So this is the Social Security scheme again. The child tax credit, massive, would go up from $3,000 up to $8,000. I mean, that's insane. Up to $16,000 if you got multiple dependents, which is good. I think that's good. But guess what? They're basically, I think this is more of that Robin Hood mentality. This tax plan is sounding like a Robin Hood thing. But that's pretty big. And that's for the child and dependent care credit. The child tax credit would go from $2,000 to $3,000. And then there's an additional $600 credit for any children under the age of 6. First-time homebuyer credit would be reintroduced like it was back when the financial crisis was here. There's a renter credit. Not sure why they would do this, but there is renter credit that you can get, So that's just something to keep in mind there. And so let's just skip through this really quick. And then there are some additional stuff to consider. For my real estate investors out there, 1031 exchanges would be gone, unfortunately. So no 1031 exchange anymore. And then also they would eliminate the unproductive or unequal tax breaks for real estate investors with over 400,000, whatever that means. Right, something you can do now is maybe sell the real estate this year so that you don't have to deal with it next year. And then consider things like opportunity zone funds and things of that nature. And then, so some of the things you might want to consider is moving from a Schedule C to an S corporation to save on self-employment taxes. Then you might want to lower the amount of distributions from your C corporation. Move from an S Corp to a C Corp. That's something you can do. Sometimes it might make sense to move from a C Corp to an S Corp. And then also shareholder loans, that's something that you might want to look into. Accelerated income, that's something you also might want to look into. And then what tax strategies don't work, right? 1031, opportunity zones, unfortunately. And I know I'm going through this part pretty quickly because we're running out of time. But a few things you can do, try to schedule some time. Here's my contact information. You can email me at jb@badutaxservices.com, or my phone number is 773-679-7198. Once again, 773-679-7198. You can check out our website at badutaxservices.com, and we can certainly help you. We do offer a free 15-minute consultation to help navigate through this stuff. We do offer tax planning, of course, as a formal service. So essentially what we can do is we can look at the current, basically what we did is we looked at the current law versus the proposed changes. We took a look at tax rate changes, itemized deductions, tax credits, additional proposed changes, ideal legal entity structures, and what are some of the things to do next. With that being said, I thank you all for tuning in, and we'll now love to open up the floor for any questions. So for those that are on Zoom, you can feel free to unmute yourself to ask a question. You can also type in the chat box. If you're on Facebook and Instagram, you can also type into the chat box as well. And I'm sorry, really quick, we do have 2 questions that came up already. So somebody said, great webinar and information. My question is that I have a 9-to-5 in an e-commerce business. I'm not currently filed as an LLC or S Corp, and I made money last year through PayPal payments. How would I go about filing taxes at this time? So what you would do is you would file a tax return, your 1040 individual income tax return, and you would use a Schedule C to attach it to your income tax return. So basically, you'd file it as a sole proprietor, and that's something we can assist you with. But you would basically file your taxes. You would file one tax return for both your personal and the business, and use a Schedule C for the for the business. And we do recommend getting incorporated. Get incorporated ASAP. It's very important. Get your tax deductions, get your legal asset protection in order. Brittany asked, what would you recommend instead of 1031 if we want to dispose of a property and avoid paying the taxes? Buy more properties. Right? What would I recommend? You buy another property, because technically a 1031 is buying another property. You buy another property and you do accelerated depreciation, aka cost segregation, so that you can use the depreciation, which is a deduction that you can get on your rental property, and you can use that to offset the sale or the income on other sources of income. And then somebody asked, is there a limit as to the amount you can contribute to traditional and Roth IRAs? Yes, it's a $6,000 limit per person, and if you're married, it's basically $12,000. If you have kids, you can put $6,000 and dump it in each of their accounts, assuming they have earned income. So that's just something to keep in mind. $6,000 if you're over the age of 50, or if you're 50 or over, it's $7,000. Keep in mind, under Biden, you cannot deduct, you cannot use traditional 401ks or IRAs, essentially, but you do get a credit for contributing to it. So basically, you just do a Roth, essentially. Any other questions? And I know that was a lot that we just covered today. So remember, this is proposed, but it is most likely going to happen. So we've given you the information. You do whatever you want with it, right? Take it with a grain of salt. Analyze it, think about it, see what you can do. Talk to us. We can help you navigate through the lenses. And if you do want to do anything, we can help you implement that strategy as well. So we still got about 6 more minutes now for any questions. Is there anyone that has any questions? All right. Somebody said they have a 403B. How will Biden plan? Yeah, basically you don't get to deduct it anymore. So 403B will be gone. It would now be an after-tax account, but you get a credit, right? And this is why I so much promote the Roth IRA and 401k and Roth and after-tax accounts, because you don't ever have to pay the taxes on it once the money is in and once it keeps growing. So now they're going to force you to do a Roth, but they're also going to add a tax credit. So for those that were already doing Roth, and you meet the qualifications, you now get a credit for that. So that's pretty sweet. I think that's very, very sweet for sure. All right. Do I think student loans will be forgiven? Yes, I do think so. Because of the fact that the Democrats won the House and basically the Senate, and we'll have a Democratic president. And, for lack of a better term, excuse my French, all hell will break loose. And so that means that stimulus, I think we'll be in $10 trillion worth of debt by the end of 2022, if not 2021. I don't want to say 2021, but I think by 2022 we'll probably be in 10 trillion. That means student loans will be forgiven. A bunch of stimulus will be out. maybe up to $10,000 worth of stimulus checks instead of the $2,000, which the Republicans shot themselves in the foot by not passing. And now it might be $10,000. So for some, that's great news, and I think it is great news. But at the same time, somebody's got to pay for it. Compared to other countries, are we doing okay with debt? No, we're not. We borrow way too much money. And have you ever thought about where does the money come from? Like, we're in $3 trillion worth of debt right now. Where does that money even come from? Yeah, we are borrowing it. And they just keep printing the money. Exactly. Just made a good point, Brittany. It's at the Federal Reserve. They keep printing the money. Next thing you know, the U.S. dollar gets devalued. Next thing you know, they keep increasing taxes. Next thing you know, we're back to where we are. So it's like, where do they keep getting the money? All of a sudden, it's from the Federal Reserve, where they keep printing money and then they ask you to replenish it. So that's what we're going through right now. So over the next 4 to 8 years, and potentially for the rest of time, this is what we could be looking at. So with that being said, remember, this is recorded. I would really take some time to take notes, maybe go back through and really pay attention to some of the things we talked about today. I will be doing this again on the radio next Monday. And so either next Monday, I don't have my calendar in front of me. I'll announce it on social media, but either next Monday or the following Monday, we'll basically have a webinar. And Brittany asked, where can we access the recording? It'll be posted on YouTube. So yes, we do often post our content on YouTube. And right after this, if you go on my Facebook and my Instagram page, you can actually rewatch it right away. YouTube one, it takes us time because we have to edit it and we have to, get it nice and pretty. So the YouTube one would take a while. So I do have a YouTube channel at Jeff Badu. That's where I post a lot of content, a lot of the stuff out there. Shameless plug, go check out my book, Infinite Expansion, How to Infinitely Expand Your Vision of Abundance. A book that was written, it's available on Amazon, a book that was written before the pandemic, but ironically became so relevant to the pandemic. And we're still in 2021 in the pandemic. Who could have predicted? So that's just something to keep in mind. We really, really have to pay attention to this stuff, because if we don't, it's going to really impact us. So for those, especially with the Biden plan, doctors, lawyers, those highly compensated professionals that may not have a business, this is something, or even do have a business, this is something that you really, really need to pay attention to. Those are the folks that are going to be most impacted. So with that being said, let's do a last call for questions. And if not, then we'll go ahead and wrap it up. Last call for one more question. All right. And thank you too, Tiffany, for joining. So with that being said, let me go ahead and stop the recording. Thank you guys for being a part of this. Hope you learned something from this webinar today. We typically do at least one webinar a week, and if not, I do my radio show every Monday night from 7 to 8 p.m. Central, and we do stream it live on Facebook too, so you can check it out. If you're in Chicago, tune into your car, 98.3 FM, and you'll catch me live from 7 to 8 p.m. every Monday. Some Mondays I don't, because I have other commitments, but most Mondays I do. So with that being said, hope you have a productive rest of the day. Please stay away from from the White House, and we'll be in touch. See you guys.